This is Robert Kraft, and I'm your host on SNN.Network. And with me today is someone who I want to preface this. We don't always want to just talk to him when the market's doing what it's doing today. I love his positive insights also when it comes to what's going on in the financial markets. But look, this is a historic day. I thought it would be great to have none other than Chris Irons, Quoth the Raven himself, on the program. So Chris, welcome back, man. How you doing today?
What's up? I'm good. First off, you're lying. You only get in touch with me when the market's taking a salad like it is right now. And that's the only time I hear from you anymore. You know, it's like, but that's okay though, because you were one of the first dudes to ever invite me to a conference or anything. So we're cool all the time. But I'm just saying, don't lie to people and tell them that you're hitting me up on 500-point upswings, because I never hear from you then. No, what's going on? And congratulations on your new baby too, by the way.
Thank you, man. I really appreciate that. And you know what? I promise you, on the next 1,000-point upswing, you're coming back. I promise. I'm gonna get.
Okay, good deal.
All right.
It could be tomorrow.
We don't. Who knows? I mean, look, as we speak, what it was when we were just getting organized, it was 7%. Now it's down 8%. I mean, look.
Right now, the Dow futures are down 2,000 points right now. I'm looking at the screen next to me. So that is a move of minus 8%. We don't have another circuit breaker until 13%. So if you're at home watching the show, your nuts might be tingling. You got another 5% until the next circuit breaker comes on. So pucker up your buttholes a little bit. Could get interesting.
So let's give my audience some context. Look, you've been tweeting about what's been going on, nonstop, probably for the last 2-3 months. I mean, even more so than that, but really covering it, breaking news, all that kind of stuff. So let's get some context as to what's been going on for those who may have had their head in the sand for the last 3 weeks or 3 months.
Well, anybody that knows me and listens to my podcast knows that I've harbored a long grudge with the Federal Reserve and with central banks that dates back to basically as soon as I figured out what they were doing. So the day that I began to have an understanding of fractional reserve banking and central banking, and the day that I started to figure out macroeconomics was really the day that I started to take exception with what the central banks do. Because I believe truly that it is a long con and a Ponzi scheme of sorts that they're eventually not going to have an answer for. And right now, the pressure that the coronavirus is putting on the market here could be backing the central banks into a corner where, they don't have a lot of room to cut rates. And it's going to be the ultimate test of whether or not all of this arrogance and assuredness from the central banks over the last 10 years, 20 years of they know what they're doing, and we got to hit this 2% inflation target, and we need to cut rates when the market's at all-time highs, and we need to do anything to stimulate the economy. Now we're going to find out if those policy prescriptions are true and accurate, because they don't just have to work when the market's going up. They need to also work when the market is taking a shit like it is right now. And so what are they going to be able to do to alleviate this, if anything? So over the long term, I've been very skeptical of central banks. And I have, publicly, if you look at my Stansberry conference speech from October 2019, it's on my YouTube channel, I said I'm here to call the Fed's bluff. I don't think they know what they're doing. Furthermore, in addition to that, you have Fed governors like Neil Kashkari on Twitter openly mocking and ridiculing hard money people, gold bugs, and Austrian school people that believe the same things that I do and that are skeptical of the Fed. I think there's an arrogance and a hubris there that will be their undoing. And I don't know if it comes with this bubble burst or the next one, but at some point, something will have to give. If you price fix interest rates, which is what the Fed is in the business of doing, anytime you price fix anything, whether it's interest rates or the dental floss you buy at the supermarket, the supply chain has to change accordingly, the demand changes accordingly, all these other variables change accordingly. The same thing happens when you price fix interest rates. When you try to tell the market interest rates should be a price of how much supply of money there is to lend and how much demand there is to borrow money. But when you tell the market, hey, rates are set at this point, all these other variables have to adjust according to the fixed point. And I've argued over the last, 5, 6, 7 years that you can't do that. You can do it for a little while, but you can't do it for a long while. So over the long term, that's what I've been arguing. more lately, what I've been arguing, since this coronavirus thing started in late December, early January, I was one of the first people to point it out and say that it presented an existential threat to the markets. I said it, if you look at my Twitter feed back in January, I was ridiculed and called a fearmonger and a conspiracy theorist. I wrote a piece on February 2nd saying I didn't think that we should trust the data that was coming out of China. I based that on a half decade of experience working to reveal U.S.-listed China-based frauds, which is what I did for a living, and really a decade of experience now, as a short seller, as a market skeptic, as a market participant, as an analyst. On February 2nd, I said I don't trust the Chinese government. I drew some very basic conclusions based on what was publicly available about the spread, about the infection rate of this coronavirus. I coupled that with some of the images that we were seeing and some of the reports that we were getting out of China, not just from social media, but also from reputable sources like, Eunice Yoon at CNBC and other reputable reporters. And, by the middle of January, I was very convinced that this presented an existential threat to the market, that it presented an existential threat to the global economy, that it was a unique threat because it was one that we were not going to be able to subvert by printing money. It's a biological problem. It's not a systemic financial problem like the 2008 financial crisis was. And I've been very verbose in making that point since the middle of January. So on February 2nd, I wrote this article, basically saying why I doubted China and why I think that we should start to look at data outside of China. On February 22nd, I wrote another article basically urging the United States to take many of the actions it still hasn't taken, like cutting off all international travel and things of that nature. I knew that we were weeks behind the curve with this. I knew it was probably already in the United States. I knew that the lack of testing was a big problem. That's the reason that we're just now starting to see the numbers expand. On February 8th, I did a podcast on my podcast called the Quoth the Raven podcast that I called Pandemics and Other Things That Make Stocks Go Up, basically ridiculing the market's move in early February as the market rallied on news of this disease, of this virus rather, spreading across the globe. And for that, I was also called a fearmonger. I was called a conspiracy theorist. And so just yesterday, now with the shit finally hitting the fan and the chickens coming home to roost and the United States government still several weeks behind the rest of the world, and the World Health Organization coming out only today and finally saying that this is a pandemic now that it's in something like 90 countries and over 100,000 people have been infected, which of course anybody with half a brain was calling this a pandemic 4 weeks ago, 6 weeks ago, at the same time as the World Health Organization was doing press conferences jerking off China and telling them what a great job they were doing and not leveling with the rest of the world about what the potential problem could be here. I was trying to just get that out there. And so I've done various podcasts appearances since then, laying out the same thing. And now that the shit's hitting the fan, I did a Periscope yesterday and said, well, you can expect to hear from me a little bit less. I think now is a point where we should expect the death numbers to go up. We should expect the infection numbers to go up. I think if you hang on and cling to every single death that occurs from this point forward in the United States, it's going to be a very gut-wrenching exercise. I think, for me personally, as I said on my Periscope yesterday, I was at a level like here in January and February where the level of average person complacency with this disease, or with the virus, was down here. And I think that then that kind of gave me the appearance of somebody that was a fearmonger. Now I think that it's finally hit the mainstream media. The level of complacency is here. And I'm kind of the one saying, all right, well, let's see what the reversion to the mean looks like with the fatality rate when we get some more data outside of China. Let's see what happens when the warmer weather comes around. But the market is panicking, and investors are panicking because this is going to be a significant shock to the global economy. I've taken exception with the fact that the global economy has kind of separated from the stock market anyways, thanks to central banks. That can be a good or a bad thing in this situation, however you want to argue it. And from here, it's interesting. We got another black swan over the weekend when Saudi Arabia and Russia both came out and said that, they're going to flood the market with oil supply, and they don't really give a fuck what anybody thinks. So you have a black swan on top of another black swan. And that's why we see the market hitting circuit breakers downward. All the while over the last couple of years, sorry, I'll finish right here.
There you go.
I've been letting people know that complacency can become very dangerous, and that it's very important to understand that there's always risk in any situation. And no matter how low the VIX goes, and no matter how high the market goes, past performance isn't an indicator of what's going to be coming in the future. And today, we see a huge shock to the system in general, and especially long-only investors, and a much-needed reminder that things aren't always okay all the time. And that's okay. That's nature.
It's cycles. I mean, look, I think any investor and who's been at this for much longer than myself. I mean, look, I wasn't an active market participant back when they're, in 2008, 2009. So I have only a vague recollection of, what happened during a global recession. And I don't mean to say that to make an implication that we are now in that, or this is a signal of that potentially coming. But a lot of people are now saying that this could potentially be coming, and the main thing I wanted to hit on with you is because a lot of people that I've been hearing, they say that there's been such a overweighting or overvaluation of a lot of companies that are, big cap, blue chip companies, and the coronavirus, COVID, and especially now with the news from, out of Saudi Arabia and oil prices, these are kind of the nails that are busting the balloon, so to speak, So what's your take on that? I mean, do you kind of agree with that?
I think on that side, it makes a lot of sense. I would just remind people that, valuations even now with the S&P back down to 2760 after it was at 3,300 prior to this, even now, price to earnings ratios are still, when you go to look at those blue chips that you're talking about, we're talking about a pullback for many of them from a PE of between 25 and 30 down to a PE of between 20 and 25, which, by historical means isn't anywhere near cheap. Stocks would have to get cut in half from here to find deep value, in 2008, stocks were trading at 7 to 12, 7 to 13 times earnings. We're a long way from that. The question is whether or not this is the event that gets us there or not. But the point is to inform people not to be completely fooled and think just because the Dow pulls back 2,000 points in a day that all of a sudden everything's cheap, because that's not necessarily the case.
Mm-hmm. So I got to ask you,
if you had applied that thinking to the last couple of weeks here and you've been buying the dips on the way down, and chasing your losses, it's been a pretty catastrophic scenario because the market it's gotten demolished over the last 3 weeks.
So let me ask you this. I mean, as an active market participant yourself, I mean, you whether you prepared for this day or not, or actually, so this is a two-part question. Let's say you prepared for a day like today to happen. As an investor, what should you have done, or maybe for the next time something like this happens? And now, as a participant who wasn't totally paying attention, they got their retirement accounts, this day happens, and now okay, what do I do next?
Well, I don't tell people how to invest and how not to invest, but what I'll do is tell you what I do.
That's right.
And that is, I always have an oversized, overweight position in, defensive things, notably gold and silver. I do like to own a good amount of gold and silver, gold miners. I think gold's move here, even though it's gone from 1,200 to 1673 over the course of just a couple of months, I think is still just the beginning. Gold I see as a win-win for a couple of reasons. One is if they're going to save this market right now, they're going to do it by some type of economic stimulus, some type of money printing, okay? So an ounce of gold is measured by dollars when the purchasing power of the dollar continues to get crippled as inflation of the money supply continues as a result of economic stimulus. The market may rally, but gold is probably going to rally with it as well. So I like gold as a preservation of wealth that you've accumulated already, because you can't put your cash in a bank and get interest on it anymore. That doesn't exist. And if you leave your cash at home and put it in a safe, you're going to lose 2% a year. If the Fed hits its inflation target. Inflation is probably more like 3-4% right now, and it's probably going to go higher in my estimation. On the other hand, if the shit hits the fan and the Fed is not able to save the market, or there is a confidence crisis in the Fed, or hyperinflation, becomes a thing, or any one of these catastrophic scenarios happens, gold is also going to be bid because it's traditionally a safe haven asset. It's been a store of value, and it's been used as an economic instrument for thousands of years. That's not going to stop anytime soon. The central banks know that it's really the only real money, which is why they hold it in reserve. So I like to be overweight in gold. And then from there, once I have my kind of core position in that, and through different means, I own gold ETFs, I own gold miner stocks, I own physical gold. From there, then you can pick and choose, your longs and your shorts and on your equities, which I also do, and your trades and things like that. But for me personally, the idea has been diversification, but not the traditional means of diversification where you divide your money up between stocks and bonds and a brokerage account. Mm-hmm. The diversification that I use for myself is physical diversification, money spread across different brokerages, different banks, in the case of some kind of systemic shock, things that I can physically reach out and touch. So, gold that I can physically hold that I don't need to go get from a safe deposit box, or I don't need to, try to take delivery on a futures contract or something like that. And just try to get yourself as diversified from the dollar as possible too. So, and that's really the best that you can do. And, I own a little bit of everything. I own a little bit of, real estate. I own a little bit of every sector. I nibbled some stocks today. But I'm always going to have that big core position in gold and silver.
Gotcha. So, as you said, joked at the beginning, I only call you when we're on these major down days. So we're going to get a little sunshine and flowery here, dude. So what are some of the positive takeaways that you could see from a day like today and from some of the news flow?
So on the virus front, there's a couple of, positives. There's a lot of reasons to be very cautious about this and take it very, very seriously.
Of course.
A lot of reasons. Having said that, if you wanted to try to point out the positives, it's that, now that the mainstream media has it has created a sense of urgency in the administration. I think every medical expert and health professional in the world is working on trying to come up with a therapeutic and a vaccine for this right now. And while that's a lengthy process, the clock is running, which is a good thing. So they're on the case at this point, which is good, even though, in my opinion, we're about 2 months too late. Not too late, but 2 months late. So I think those are good things. I think the heat coming in the summer could possibly slow the transmission of this thing. I think hopefully as more data comes out ex-China, we find out that the fatality rate is perhaps lower than we estimated. We'll also start to get a good idea as to whether or not China's numbers are bullshit or not, which I happen to think that they are, simply because their response to the virus has been incongruent with the numbers that they have posted, and also just from my personal experience in dealing with U.S.-listed companies and having a feel for the ethos of the Chinese government. Those are both positives. I mean, if you want to talk other positives, I think that it'll be difficult for Saudi Arabia and for Russia to keep oil prices this low. Russia claims that they can do it for 10 years. Maybe they will. Maybe I'll be wrong. But in a situation like this, crude's printing 31 1/8 right now. I think, crude starts getting into the 20s. It's going to be a little bit more difficult for them to kind of maintain that. And I think they're doing this to make a statement here, to make a geopolitical statement, to cause a little bit of a ruckus. They know it's a bad time to do this. They know a lot of American shale companies are over-levered right now. This is going to cause a lot of companies in the Permian Basin to go bankrupt. I mean, that was already kind of turning into a shit show there over the last couple of years. You had all these oil and gas kind of companies popping up, putting their wells too close to each other, taking up limited amount of space. Many of them were incurring losses, were not returning the numbers that they had pitched to their investors. The Wall Street Journal did a couple of great articles on the Permian Basin over the last 6 months, 12 months. A lot of those companies have taken on leverage to try to restructure. They're all fucked for the most part. A lot of those companies are going to get washed away, which is good because that's what should happen to malinvestment. But I think, Russia and Saudi Arabia are kind of doing this to make a statement. I don't think it's going to last forever. So I think if you are interested in looking at that space, you look for oil and gas names that have been around for a very long time, have a very, very secure balance sheet, have paid a dividend without stop for, decades in a row through 2008, through 2000. And I think there will be some generational opportunities in oil and gas here. If not today, I think crude will probably have to come down back into the 20s. There may be some opportunities there. With that also being said, I think there's some opportunities in other equities also, too. I just tweeted out that I was buying some shares of U.S. Bank, which is a regional bank that has basically seen, 40% of its market cap just get crushed. A lot of the banks are falling because interest rates have fallen. But that was a regional bank that was targeted or was rumored to be targeted by larger investment banks. Goldman Sachs, JP Morgan, these big banks are all going into retail banking now. So I think somebody might come by and scoop that up, like a Buffett or something like that also. There's going to be a generational opportunity in airlines, which I think will get bailed out. I do not think the same will happen for the cruise industry. I think the cruise industry is fucked. So I think you have to tread very carefully, pick and choose your spots, but I do think there will be some things that you can buy as the market continues to crash. If it does, that you may be able to really put away for a while. And even in the case of, the United States hitting stagflation, which is a possibility, companies like airlines, if air travel becomes a thing again, and it will, just like after 9/11, it took a long time, but it became, ramped back up to full blast at some point again. That will happen again, and you'll have, maybe a decade or two of good yield and some equity appreciation. Who knows? So
Gotcha.
There's going to be spots. You just got to pick and choose very carefully, and don't rush to get in just because the market is, sold now. Because people say, people that look at charts say, oh, it's oversold. And I always say, well, it can always get oversolder, the fucking RSI doesn't mean anything, the market wants to go lower, it's going to go lower.
All right, I think that's a good place to end it. So, Chris, where can my audience go and find more information about you, your podcast, and all of your insights?
They're resourceful people. They can find me. I don't want to tout my own stuff. I'm not very self-promotional.
Just give the website.
Remain skeptical and think for yourself. Don't let the fucking Fed or CNBC do your thinking for you. And I hope we can talk again soon, brother.
For sure. All right. I'm going to tout you then for you. You can follow him on Twitter at QTR Research. And look forward to speaking with you soon. As I promised, on the next 1,000 points swing up, you're coming back on.
Yeah, you got it. Might be this afternoon with the way things are going. Actually, it looks like the market's getting porked here again.
Oh, really?
So it looks like we're Dow futures are now down 2,006 points. What do you think about that shit? Woo, it's a spicy meatball, huh?
It's a spicy meatball. All right. I'll see you later.
All right, brother.
Peace.
Talk to you.